The top 10 tax changes for 2022. There's a slew of them. We've picked out the top 10 here at Nelson Financial Planning. And so on this week's program, we're going to be joined by one of our certified financial fiduciaries, also happens to be a CPA, Kristen Cayley, to work through those top 10 tax changes. That's going to be pretty important here in a couple of weeks or so when folks start getting their tax documents and you start getting organized and filing your 2021 tax return. So we've got that on the program. Welcome, of course, to Dollars and Cents. We happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you're subscribing to us on your favorite social media podcast channel of choice. My name, of course, Joel Garris. I'm a certified financial planner and a certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries, just like Kristen Cayley, stands ready this week. Maybe you want to start the year off with a New Year's resolution of getting your finances in order. Well, that would be just the opportunity to come on in and have a conversation with one of our certified financial fiduciaries. Of course, those consultations always free of charge, as they have been for over 35 years at Nelson Financial Planning. This time of year, of course, here in early January, sort of mid-ish January, I guess already, right? Hard to believe, mid-January, folks are getting their annual statements. And here's what I want everybody who listens to this program to do. You get the annual statement, and I want you to take a moment and review it. Please, just open the envelope, or if you've gone with that whole electronic delivery, just click on the email and actually look at your statement. Because what's neat about the statement that you're getting right now is that it's an annual statement. It shows the calendar year 2021. And there are two things on there that are most important that you should be able to readily find if you're looking at the statement. If you can't readily find them, then maybe you need to ask some questions about what's on your statement. But here are the two things. Number one, performance. How'd you do? Number two, how much did it cost you? Those are the two most important things. And you know, what's interesting, for years is we've been running advertisements talking about investors that we see all too regularly who are overpaying for underperforming advice. And so that's why it's so important to look at those annual statements. You may say, well, you know, what are you talking about, Jolie? Overpaying for underperforming advice. What exactly does that mean? And what is it that you're talking about when we have those advertisements? We talk about it on the radio program in terms of what you see when people first come into your office. What do you see that's this underperforming, overpaying problem that we see throughout the financial services industry that unfortunately means that investors are not doing as well as they should? Well, let me just tell the story of what we saw just this past week. So a client, well, now he's a client, one before, got his annual statement and actually looked at it, reviewed it, looked at it, been listening to the radio program and listening to the podcast for many years, took an opportunity here once he got his annual statement to actually look at it. And of course, then that became sort of the precipitating factor for picking up the phone, giving us a call at the office and saying, hey, I want to sit down and chat with you guys, because here's what his statement showed. This is a statement. He was obviously with a major financial services player in the industry in the early 60s, and it was an IRA. Balance on January 1 of last year, $265,144. Problem is, on the balance on December 31, $265,731. That is a profit of $587. And no, he did not take any money out of the account. Still working, early 60s. This is an account that's supposed to be percolating along to help generate out additional income in retirement. So let me say that again. On a $265,000 account, he made a profit of only $587 during a year in which the overall markets were up 28%. Now, I get it. Overall markets, okay, that might be a little bit too aggressive, and I would agree with that. If you've got a 100% equity portfolio, that's got some aggressiveness to it. Certainly in your early 60s, you wouldn't want that. So let's dial it back. Let's say it was a balanced portfolio. If you look at a balanced portfolio, it would be about 60% stocks, 40% bonds. For last year, 2021, not uncommon to see returns maybe 12, 13, maybe even close to 15% on that more conservative balanced portfolio. Again, if you're doing the exercise, if you're looking at your annual statements, you want to compare it to what happened for the type of portfolio that you had. Well, there wasn't any portfolio last year that should have made only $587. Now, here's the problem. Portfolio is sitting predominantly in bond funds. And what do we know about bond funds? As interest rates move up, bonds go down in value. So that was a big problem with his portfolio because we had gone in and had the conversation with the particular individual he had previously been dealing with. He was told what he wanted to hear and not what he needed to hear. And folks, that's the difference between being a fiduciary and not. Because in our opinion, the difference between being told what you want to hear versus being told what you need to hear is what it's all about. And in this particular case, they were simply told we're nervous about the market, we're nervous about the future, we're nervous about the election, we're administration, taxes, blah, blah, blah. List goes on and on. Great. I'm going to give you a portfolio that's exactly what you want. No conversation about what you need, where you are, whether you're going to need to get some income from this, none of that. Now, here's the worst part of the story. Because you're like, how can the story possibly get any worse, right? Here's the worst part of the story. Profit of $587, right? The fees paid for the calendar year 2021 in that account, $4,696. 8 times more than the profit. And what's even worse about that is that's the fee that they paid the advisor, coming to 1.75%, which doesn't even include the underlying expenses of the investments that were being used. So all in, probably about 2.25%, 2.5%. Pretty dramatic. They paid $4,696. They made $587. Just wow, right? I mean, can't say anything more than that. Crazy. And that's a pretty unfortunate situation, especially with the kind of approach that we see, somebody approaching retirement. So bottom line, please, please, please check your annual statements. Check your statements now. How much did you do last year? How much did you make last year? What the fees were? Should have been north of maybe 10, 12%, even on a more conservative balanced portfolio, 60% stock, 40% bonds. So did you do that? More importantly, how much did you pay? Make sure that you take the opportunity to check that annual statement that's coming in the mail right now to your house. We're going to take a break. When we get back, we're going to be joined by Kristen Cayley, our CPA at Nelson Financial Planning, to talk about the top 10 tax changes for 2022. Coming up next here on Dollars and Cents. The top 10 tax changes for the year 2022. We are joined in this segment and probably for the rest of the program, because we've got a lot of things to talk about in terms of tax changes, by our fellow certified financial fiduciary at Nelson Financial Planning, Kristen Cayley. She also happens to be a CPA. So welcome to the program.
Thanks, Joel.
Or should I say welcome back. You've been joining us on a somewhat regular basis because there's been a lot of tax changes over the past 6 months to chat about.
Yep, and also some proposals too that never actually did get passed.
Thank the good Lord on a lot of those, that is for sure, because there were some that we were quite concerned about. Should they have become law? That is for sure. But there were two big pieces of legislation that did pass, and what were I guess they always have good formal fancy names, right?
Yeah, so it's the Consolidated Appropriations Act of 2021 and also the American Rescue Plan Act of 2021.
Leave it to Washington to come up with great marketing names, right? I mean, they really should be in sales, and I think that's kind of what being elected is all about, right? Anyway, I used to do this top 10 list for many, many years. You over the past few years have kind of taken it over and been writing it. And one of the things that I always found that was the hardest thing to do was to actually just limit it to 10 things. So at the end of the conversation, I'm going to ask you about one of the things that you wish you had an 11th, right? So think about that when we get through that. But so that's some big major legislation that happened during the course of the year. If our listening audience wants to get a copy of this top 10 tax changes, we're mailing it out, of course, to all of our clients at Nelson Financial Planning, but we're also going to be posting it on Facebook and LinkedIn. Our website, LinkedIn, all of the different social media platforms out there. So if you want your copy, we'll probably also do it as a blog post too on the website. So if you would like your copy, go ahead and just look us up on the social media channels, and you'll find your copy of this top 10 tax changes for 2022. So let's get it kicked off. What's the biggest one?
I'd say the stimulus check, the third one that came out last March. So we've seen this before in 2020 when the first and second stimulus checks came out. So this third one was for $1,400 and was generally received in March. But the difference between this one and the others is that it may have come to you as a debit card. So it may not have been a check or a direct deposit. It may be a debit card.
So you would have had to really look through your mail. And I guess that's the problem, right? So if you missed it in the mail or you threw it away because you thought it was junk, and the IRS says we sent it to you, who wins that debate?
We've only seen the IRS one so far.
That's what I feared. That's not good at all, because there's no way to fight the IRS, which is just unbelievable. And well, shoot, I mean, the Journal had a editorial piece in it this past Friday, and it talked about the millions of returns that are still outstanding. I, for one, still have not gotten my refund. It's 3 months and counting, and there are several million returns in that basket. If you call, the call volume is 3x more than what it has been in the past. Just some unbelievable kind of statistics when you look at what's going on in the IRS and how far behind they are, and their inability to sort of pivot to technology. We'll probably talk a little bit more about that later on. But so the third stimulus check, and what we saw last year was these stimulus checks really do create a big headache for taxpayers.
They do. So you need to know the exact amount of the stimulus check you received. And there are those thresholds. So if your income was over the limits, which were $75,000 for single filers and $150,000 for married filers, there is a threshold where if you go a little bit over that, you can get a reduced amount of the stimulus check. But we need to know the exact amount to the cent.
So it could have been like an odd amount, like $369.22 or something like that. So you're definitely going to have to kind of know what you got and do the research. And I remember last year and that's part of why the IRS is as far behind as it is there were so many people that said, oh, I didn't get it or didn't realize that they got it. And so you put it on the return, and then the IRS is literally like back checking all of those. Mm-hmm. And so that's creating a huge backlog at the Internal Revenue Service. So the good thing about the stimulus check, though, is that if I get it, I don't have to give it back no matter what.
Right.
So that's a pretty unique feature where even if you maybe didn't qualify for it and you somehow got it, then you don't have to worry about giving it back. But if you didn't get it and you're eligible for it, how do you wind up kind of dealing with that?
So that's on the tax return. So you would just tell your CPA, or when you're filing your own tax return, you would say that you didn't receive it. And you'd receive it in the form of a credit, so it could reduce your tax liability or it could increase your refund.
So that's good. So definitely and that's probably one thing that taxpayers really need to take the time to really research and remember, try and make sure to find exactly how much came in and when it came in. Okay, so that's number one. What's number two on this top 10 tax list?
Kind of along similar lines, the advanced child tax credit. So if you have younger children under the age of 17, you probably saw back in July they started sending out advanced payments. So it turned out to be $300 for children under the age of 6 and $250 per child under the age of 17. And this was just a monthly payment that they were sending out. It could have been direct deposited, it could have been checks in the mail. The Iras just started sending it out based upon your 2020 income.
And again, what's crazy there is we heard stories of some people getting it, some people not, some people getting different amounts from one month to the next. I mean, it just was all over the map. Now, in this particular case, there's a specific way that people can sort of verify what they actually got, and there's a separate form for that. What is that one?
Yep, so that is going to be letter 6419. The IRS is sending it out sometime in January, so they may have started coming out already. But this will tell you the exact amount of those child tax credit payments that you received, and you're going to need to report that exact amount on your tax return.
So they're sending out a letter on the child tax credit that says, okay, here's how much, according to our records, the IRS, that we sent you. Good luck challenging that, as we talked about previously. But there's no such letter for that stimulus check, right? I mean, you're there. What do you have to do to kind of figure out that?
So I believe there is, but there's been some confusion about when it's been sent out. It might have been sent out in March of 2021, so people probably just discarded it. But that was letter 6475. But I have read they might be sending it out in January just because they learned from last year there was so much confusion about what people actually received. So it might be coming in the mail. Well, to be determined. To be determined,
and certainly something that we will keep our listening audience posted along the way. So that would be certainly really, really helpful, because a lot of the issues last year were folks that just couldn't remember or didn't realize, or maybe got that debit card and threw it away. The reality is, though, so hopefully they will wind up doing that. So there's potentially a letter 6415 and then a letter 6419. The 6419 we know is coming out. Mm-hmm. That has to deal with the child tax credits.
Right.
There's another unique thing about the child tax credit, and what is that?
If you're not eligible, you have to repay the full amount.
It is not like the stimulus check, ladies and gentlemen. The stimulus check, if you get it, doesn't matter, you get to keep it. With the child tax credits, if you get them and you're not eligible based upon your tax return, then you've got to give that money back. So there could be some surprises lurking, particularly for young families with kids on their tax returns. So that's pretty dramatic. So those are certainly some big item one, big item two. What's next on the list of this top 10 tax changes for 2022?
So I'd say the coronavirus-related distributions. We saw this come up in 2020. This is if you could take up to $100,000 out of your retirement plans, just as a way to get through the pandemic. So if you did that last year, you have the ability to repay up to the full $100,000. But if you don't repay anything, if you elected to have it split up between 3 years, you're going to have to report a third of that income this year.
Yeah, so you could have it if you did that and split it up. You may have forgotten, and you may have an extra chunk of income on that return that you now have to deal with. All right, so that was number 3. We're going to take a break and continue on with the conversation about the top 10 tax changes for 2022 here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. On the program, we're talking about the top 10 tax changes for 2022. It's an annual exercise we do at Nelson Financial Planning. For many years, I was the one who was doing it and writing it up. And over the past few years, Kristen Cayley, our CPA and also certified financial fiduciary at Nelson Financial Planning, has been writing it up these past few years. Hardest part of that is finding the 10, right? Mm-hmm. There's usually a lot more than 10 so you got to kind of pick the top 10. So we went through the first three: stimulus checks, child tax credits, and coronavirus related distributions that really only applied to distributions in 2020. Mm-hmm. So what's next on the list?
So unemployment benefits. So last year we saw a lot of people collecting unemployment benefits, and they were fully tax-free. But starting in 2021, they are going back to being taxable. So those benefits, last year you could exclude up to $10,200 of unemployment benefits from income, and that saved people a good chunk of money. I'd say between $1,000 to $1,500. It
certainly did, particularly if you think about it. And again, this was in the year 2020, so a lot of people wound up collecting unemployment for perhaps the first time in their lives as a result of the economic lockdowns and shutdowns. And the surprise when you get unemployment is that it is in fact fully taxable. That was a special feature that they did for 2020 to make it not taxable, or at least up to that $10,200. And now it's back to kind of normal. Mm-hmm. One of the more frustrating things that we see with that, and it kind of goes with the issue of identity theft as well these days, is that there were a lot of folks, a lot of fraud in terms of collection of unemployment. And so what we ran into a few times last year was this frustration that folks are getting tax documents saying, oh, I got unemployment benefits, when they didn't get unemployment benefits, and that's because someone had fraudulently done that by stealing their identity. I mean, there's not really a good solution for in those situations, is there?
No, unfortunately not.
Once again, the IRS very far behind the 8 ball and impossible to talk to. And so that was one of the, I mean, talk about a real wrinkle in the conversation, is if you're getting a tax document that says, oh, you got unemployment benefits, and the reality is you didn't. So anyway, so what's next on our top 10 list?
Yep, so we got some changes related to charitable contributions. So there's changes for if you itemize, and also if you just take the standard deduction. So starting with the standard deduction, a lot of you saw last year the CARES Act of 2020 created a provision that let people take a charitable contribution as an above-the-line deduction, which meant that anybody that didn't itemize could still deduct up to $300 of charitable contributions.
Okay, that's not a whole lot.
Right.
I mean, that's a pretty limited. That's a pretty limited amount. I mean, good that they did at least something on that, because more and more people find that they are using the standard deduction, so they don't necessarily get any direct benefit, if you will, from a tax perspective on a charitable contribution. So this was an attempt to resolve that, but that's a pretty limited amount.
Yeah, so it has increased from 2020. So last year it was $300, no matter if you're a single filer or married filer. For 2021, we can have, it's $300 per tax filer. So if you're married, it could be up to $600.
Okay, so a little bit better for 2021.
Yes.
So, but not still
not
too much, but a little. They at least fixed that issue where it was just $300 per return. Now it's per tax filer. All right. So then there was another charitable contribution change for last year as well.
Yep, so this is for people that itemize their deduction. So this also came about through the CARES Act of 2020. It increased the limitation from 60% of AGI to 100% of AGI. So essentially you can offset a larger portion of your income with charitable deductions.
Which is certainly a nice feature to have, to the extent that you're charitable minded and want to make a sizable donation to your favorite charity. Then that sort of removes a little bit of a barrier that limited the deductibility of that contribution. So, all right, so some charitable contributions. So that's good. What's next that they kind of did in terms of change? I think we're up to number 7 if I'm keeping track of things on the list.
Yep. So the 50% limit on business meals was suspended for 2020 and also 2021. And this was really to promote people going back out to restaurants and spending money. So it just has to be meals purchased from a restaurant. It could be takeout, it could be on site. It just can't be, grocery store meals or something like that.
Gotcha. So it's got to be a restaurant where there's a server, things like that, where to really help that industry, because obviously that industry was one of the ones that was most hit. So let me make sure I get this right. So this coming week, right, we are doing our annual Nelson Financial Planning dinner, right? Mm-hmm. So I got to make sure, because I don't want to mess up on my taxes. So that means that instead of traditionally where I would have only gotten to write like 50% off of that, then we get to write 100% off of that.
Right.
So that's awesome. So and typically December is always such a busy time, right, for everybody. So we always do it kind of in January to kind of get the year started. So if we get to write off 100%, is everybody going to order better wine or something? Is that how this is going to go?
Some nice steaks. Yeah.
All right. Well, that's good. So that's good if you are a business. If you're doing those kinds of things, it applied to last year and also to this year, where you get to take 100% of that. Okay, so that's good. Another nice change. The next one has to deal with sort of child independent care. So tell us a little bit about that one, Kristen.
Yep. So this credit had been around for years, but it never had been expanded or adjusted until now. So what it did was the credit used to be 35% of $3,000 in expenses for children. This is for daycare, things like that, children under the age of 13. So that amounted to about a $1,000 credit. So what they're doing is expanding it to 50% of $8,000 in expenses, which is about a $4,000 credit. So that's about a $3,000 jump in this credit.
That's a pretty significant expansion that they've done.
Right. So this is really just to get people back in the workplace, promote more daycare, just child and dependent care credits.
Well, it also reflects the fact that stuff costs money, right? And it costs more than it did a few years ago. And it really hasn't, to not adjust something like that just sort of ignores the reality of having kids and costs, and particularly now, as a lot of those costs for services like that are increasing. So that's certainly a very good one to add into the mix as well. And then certainly some changes, as there sometimes is every year, but maybe not every year, every other year, certainly some changes on retirement account limits. So how did those change for 2022?
So essentially almost everything changed except traditional and Roth IRA limits.
Gotcha.
So I'll just run through the list here. So with 401ks, 403bs, and 457 plans, the limits increased from $19,500 to $20,500.
Okay, all right, so that's good.
$1,000 boost. And the catch-up for all these plans remains the same. So if you're age 50 and older, you can add an additional $6,500.
Okay, all right. So what and folks really need to kind of remember then is that if they are putting money in out of their paycheck, right, then they need to adjust that to make sure that if they're trying to get the maximum, know that there's a higher maximum, they may have to adjust that in their paycheck.
Right.
So that's good to know. But there's a bunch of other types of accounts. So how did those limits all change?
All right. So the next one here is simple IRAs. So those increased from $13,500 to $14,000 in 2022.
Okay. So another little bit of a bump. Good.
The catch-up remains the same for simple IRAs. It's $3,000 for people over the age of 50.
All right. So we got a little bit of a change on that, and so we got another, but not the IRA and the Roth. So we'll pick that up. We'll pick that piece up when we come back after the break here on Dollars and Cents with your hosts Joel Garris and Kristen Cayley of Nelson Financial Planning. Welcome back to Dollars and Cents. We're a top 25 financial planning podcast. Plus, we're on a variety of stations throughout the Central Florida region. So we hope that you're joining us during our live slot on Sunday mornings. Otherwise, if you missed the program, make sure you subscribe to us on any of your favorite podcast channels. The program, of course, is called Dollars and Cents. Called Dollars and Cents for a reason, because we help you make sense out of all of your decisions involving your dollars. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. Speaking of the team, we're joined by one of the team members, fellow certified financial fiduciary, who also happens to be a CPA, Kristen Cayley. Welcome again to the program.
Yes, thank you, Joel.
Awesome stuff. We're talking about the top 10 tax changes that Kristen wrote up. We sent that out to our clients this coming week. And if you are interested in your own copy, then you can certainly check out our social media channels and website, where you can download a copy of the top 10 tax changes for 2022. We had made through a lot of them. I think we're kind of still on number 9 that talks about increasing the amount of contribution, or the contribution limits to various retirement accounts.
Yes. So we just rolled through 401k, 403b, 457 plan limits, and also simple IRAs.
And all of those basically went up by another $1,000. So again, if you're maximizing out those contributions, you want to adjust that paycheck withholding to make sure that you hit that higher maximum contribution.
Right.
But what's the story on IRAs and Roths?
So they remain the same. They have not moved from $6,000, and the catch-up is still $1,000 if you're over age 50.
Yeah, and these limits change based upon inflation. And so what's surprising on that is that even with this high inflation, that those numbers didn't move. I think, if I recall correctly, there's something in the legislation that says that they can't move, they don't move, they only move in $1,000 increments. Is that right? I think that's right.
That might be true, yes.
Yeah, so we're still waiting. So maybe another year or two, we'll see those contributions. We'll see those contributions go up. All right, so we're at number 10. So what's number 10 all about?
Cryptocurrencies.
Okay, tell us about that.
So the IRS is trying to monitor them, trying to just really bundle down and get those transactions reported. So the biggest change that we're going to see is that if you're a cryptocurrency broker, you are now responsible for producing a 1099-B for all of your crypto transactions.
Wow. Okay. So that's a significant change, where now those transactions are going to get reported. By generating a 1099-B, then the IRS is going to get a copy of that as well.
Exactly.
And then that will have to be reported on Schedule D, short-term, long-term, however that plays out. Then you've got to report that on your tax return. And that's a pretty significant difference, all because the IRS needs your money. So that's why they're after this crypto stuff, because as more people do it and have profit, then they're going to get more involved in that.
Right, and a lot of the newer, if you bought crypto recently on those platforms, they have been producing these. This is just maybe for people that bought 5 years ago, 7 years ago, and then you make a sale through one of these brokers, then they're going to need to produce that 1099-B.
Now, are they going as far as tracking cost basis like you might typically see on like an investment account, or is that still just kind of a little bit of the unknown on this crypto stuff?
I think it's going to be unknown. I'm not really sure how they're going to be able to track down the basis, since it's never really been reported anywhere. So I think it might just be the proceeds, and then leave it up to the client or the taxpayer to figure out basis.
Figure out basis. Yeah, so that could be a little bit of a tricky proposition, especially if you're dealing in multiple currencies, right? Buying one for the other and then back. I mean, it can get complicated very, very quickly. So that's the top 10. So one of the things we talked about at the beginning of the program was how difficult it is to limit to a top 10 list, right? A la David Letterman style. I didn't want to go top 11, top 10. So if you had to add one more, what would it be?
So I think the Obamacare premium tax credit subsidies.
Okay.
There's been a change. Well, if anybody remembers from last year in 2020, they completely removed the repayment requirement.
That's right, they did, yeah.
So for 2021, it's a little bit different. Still, it's limited. So instead of having the full repayment as an option out there, the maximum you could repay is 8.5% of your income.
So let's break that down a little bit more. So when I go on the exchange, right, I put in my income, and then when I put that income in, then it determines the advance, keyword advance, tax credit that I'm going to get towards the payment of that premium. Okay.
Right.
So in prior years, how has that worked?
So depending on where your income is, it's basically like a true up. So when you do your tax return, depending on where your income falls based upon what your credit was,
right,
you could repay a certain amount, you could repay the full amount. It really just depends on how much your income goes over what you estimated it to be.
So if you go over the line, then ultimately if you go over the line, you could wind up paying the whole thing back.
Yep, we've certainly seen that, and it's thousands and thousands of dollars.
Yeah, absolutely. Okay, so that's the world prior to all of this COVID craziness. So then we fast forward to 2020, and they just said, you know what? No matter what, we're not gonna chase that penalty. So if you busted through and you owed thousands and thousands of dollars because you misapplied or you didn't get the tax credit correct based upon how much you thought your income was going to be, then it was a freebie.
Right.
That's pretty good. But not the same for 2021.
Nope, not the same. So essentially they opened it up for people that are above the income limit. So it's typically limited to people with income that's 400% of the poverty line or below. And they adjust those numbers every year. But just for a reference, so like a family of two, that'd be about $69,000.
Okay. All right. So that's a hard line typically under the normal rules. So this would be an abnormal year where now it's based upon. So if I made $150,000, then I would be limited in terms of how much I'm paying. In that it wouldn't be more than 8.5% of that $150,000 gross income number.
Right.
So I might have to pay some back, but I wouldn't be into the problem of having to pay it all back.
Right.
All right, so that's at least good. So that's one of the things and now that's just good for 2021.
It goes back to the old ways for 2023.
So be careful. Don't get used to that and think, oh, I'm going to be able to get away with that. I missaid the year. It's good for 2022, and so next year it winds up going back to the traditional format. So that's some pretty interesting stuff in terms of those top 10 tax changes plus an extra bonus that we shared with you here on the program. The crazy part is just how far behind that the IRS is on processing things these days. We mentioned it earlier. There was a editorial on Friday in the Wall Street Journal that kind of talked about it. They just have not embraced technology, and they refuse to do that. They say, oh, just give us more people. But I think that the technology exists out there that they could be doing a much more efficient job than what they're doing. Anyway, we're going to wrap it on up and get on out of here. This has been Dollars and Cents with your host, Joel Garris, joined with Kristen Cayley here of Nelson Financial Planning.